Ladies and gentlemen, please take your seats. The show's about to begin. Mohamad, let's put on a show.
All right.
Welcome to another episode of Golden Nuggets with me, your host, Silvia Eldawi. And today I'm joined by Mohamad Kaswani, who is the Vice President of Property Finder and the Managing Director of Mortgage Finder. Welcome to the show.
Thank you for having me, Silvia.
You're welcome. We are going to talk about all things mortgages today. I've got lots of questions and the audience have questions too. So we're gonna go to their questions. I need to find out what they are actually. So, because I gave them, usually what I do is I do it the night before. I say, I've got Mohamad Kaswani on the show. Drop all your questions about mortgages, but I did it 10 minutes before you came in. So I'm sure there's some questions which we'll review. Now, Mohamad, I learned something the other day about mortgages. Do you know the origin of the word mortgage?
I sure do, and it's not pretty.
Tell us about it.
So I think it's a death pledge.
Yeah, right? Exactly that. Yeah. So it comes from the French mort, which is death, and gage, which is pledge, and it's from the 14th century. So it is kind of like a negative connotation on like a death contract.
So do we blame the French for everything that's wrong with mortgages?
Let's do it. Let's do it.
Everybody else blames the Brits, right? So
let's blame the French for this one. Okay. And you actually started your career. You're quite the entrepreneur, but you started your career a while back in mortgages.
Yep. That was more about 22 years ago. As our good friend Drake said, started from the bottom, now we're here.
Now he's here, right at the top. Yeah. And Mortgage Finder is one of is it the number one mortgage broker in the UAE?
We're the market leading mortgage provider with direct to consumer lending. Right? Okay. So that's where we are.
Clear. That's the accolade. Now, tell us about your journey from being starting at the bottom to now being here.
Oh wow! So I grew up in Damascus, Syria. Went to the U.S. in my late teens, early 20s. Went to school in Pennsylvania. Chased a girl out west. Worked at Bank of America, and then started my own mortgage company in 2004.
Did you marry that girl?
I did marry that girl.
Okay, that's good.
I'm no longer married to her, but we have two beautiful children together, and they all live in California, and I go visit them every now and then. So, story for another day. So then I started my own mortgage company back in San Jose, California, exactly 20 years ago. So around October 2004. And then sold it and moved back to the Middle East in March 2008. So that was
an important year. 7
months before the market crashed. So I was in my very early 30s, and at the time, I decided to wind down the business late 2007 and completely exited early 2008. So when I was, back in the region in 2000, late 2008, looking at what's happening in the world of financial crisis, I actually believed I was a genius because I was, young.
You exited at the right time.
And you're often too full of yourself when you're that young. So I'm so smart. Truth be told,
did you have like a clue that something was coming, or?
Truth be told, you had to have been an idiot not to see a crash coming pre-financial crisis, particularly if you were in the mortgage industry.
Right.
I take a lot of pride in having, built and ran a super clean shop at the time, but we knew what was happening around. We were talking to the bankers. We were, interacting with other brokers, etc. And it was definitely a train crash waiting to happen. But we avoided that.
Like I do talk a lot about the financial, my guests, because my guests are always have been in the industry for a considerable amount of time. We always do reference 2008 as that turning point. And we talk about the global financial crash, but a lot of people might not understand how or why it happened. Could you just give us like the 101 on Fannie Mac and Annie Mae, or what was it called?
Freddie Mac
and Annie Mae, whatever.
Look, I think if I was to use one word, it would be greed, right? And greed in the sense that customer centricity, or having an industry, right, that focuses on what is in the best interest of the home buyer, and usually home buyers are the most delicate, and they usually fall, prey to some greedy people in different industries, whether in banking and real estate, financial services, etc. And a lot of people were rushing into buying homes without having the proper financial foundation, to do so. There's a lot of malpractice in that industry, and particularly in the U.S. In the U.S., mortgages are usually originated by brokers and banks. There are more than 1,200, thousands of mortgage originators, tens of thousands of mortgage originators, in fact. And then it's packaged and sold in the secondary market. So let's say a bank originates 1,000 mortgages, and then they turn them into mortgage-backed securities, and then they sell them in packages of, let's say, 100 million. What happened was very simple. At the time, people were buying homes that were beyond their means. Their interest rates started adjusting, particularly with the exotic loans at the time. And then, the music stopped, demand turned around, mortgage payments started adjusting, so affordability wasn't there. People were forced to sell their homes.
And there were a lot of companies as well. I remember there were a lot of companies that were betting on people defaulting. I can't remember what that was called, but
credit default swaps, I think, or it was. I mean, look, it's how we evolve as a species, as human being. You would hope, and I think there's a lot of safeguards that are in place in the financial services industry, both in the U.S., in Europe, here, and globally. So here in the UAE, central bank is always very committed to maintaining lending standards that ultimately protects home buyers from making bad decisions or poor financial choices, and that definitely safeguards our market.
And what would you say? I mean, I know that was 20 odd years ago, but is there any significant differences between getting a mortgage here and getting a mortgage in the US?
Here's the unfiltered truth. I think the mortgage industry here is 20 years behind what the mortgage industry was 20 years ago when I was in it in the US.
So it's 40 years behind technically.
Unfortunately, yes. And let me quantify what I mean by behind, right? The transaction cycle is extremely slow. It is a painful, daunting journey, right? Now, I remember back then in the 2004 to 2007-8, we were originating mortgages within 48 to 72 hours, right? The average transaction cycle in the UAE is 48 to 78 to 72 days, right? So that's 24 times slower, right? And look, this is the sort of the trade-off between central bank being hyper committed to maintaining that conservative approach to mortgage lending, ultimately to protect home buyers and protect the consumers and put all of these safeguards in the industry, but it also comes at the expense of very inefficient processes, right? And I can dive into these processes and the pain that home buyers would go through. Now, we go through this pain on behalf of home buyers and mortgage finders, so we understand it very, very well, and we try to sort of shield home buyers from that pain, but we know what's happening in the background.
Yeah, because my friend just took out a mortgage recently, and she was like, I had no idea how painful just that part of the process was. Before she's even started viewing properties and making offers, it was like, that was a painful
Send her
process.
to us next time. It'll be a lot less painful.
Okay, so this episode, I really want this to form a lot of people are actually using these episodes as training programs, or, instead of a CEO doing a Monday meeting, they'll just play one of these episodes. So I really want this to be a useful episode for someone either who has just got into real estate or is in the very beginning, has never actually taken out their own mortgage. So I really want to fill in a lot of the blanks for them on that. And also tenants moving into or considering home ownership. And one product that you have on your website is that rent versus buy calculator. Can you tell us about that?
Yeah, absolutely. So it was a tool that we developed on the back of my own personal experience. A couple of years ago, I was doing some math, deciding whether to continue renting or to buy a property. Luckily, we bought. But the process was on an Excel sheet. So I started plugging in some numbers, running different scenarios. What happens if the property price goes up? What happens if interest rate adjusts? What happens with various different scenarios of that, that can happen in a property transaction. And on the back of that, we, sat with the product team and I said, hey guys, how can we build this tool to empower consumers or home buyers in making that decision objectively? So we built a tool that is called the rent versus buy calculator. You can find it under Explore. So you can just go to Google, type Property Finder rent versus buy calculator, and you'll find the link just to give you a bit of a shortcut. What we found in almost absolute terms is the one variable that makes the difference is how long you plan on staying in the property.
Right.
And we advise home buyers accordingly. We say, hey, if you're getting into the property with the view of potentially moving or selling in a year or two, maybe you're better off renting.
Because of the upfront costs involved.
Yes, right. And I don't like to look at appreciation. A lot of times people, I believe, make a mistake of treating a property purchase like a trade. Right? It's not a trade. The most important thing, it's your home.
Yeah.
Right? Particularly if you're buying to live. Right? The second most important thing is it's an investment. It's an investment in your family's future. Now, in almost absolute terms, if you're living in the property for 3 to 5 years or longer, it is always better to buy than rent. Now, that's an almost, keyword almost, absolute terms. To double click on today's market dynamics, right? And the reason why the rent versus buy calculator will almost always
encourage you to buy
or encourage you to buy is because in today's market, and this is unique to the UAE, your mortgage rates are lower than rental yields.
Right.
So if you look at rental yields, that is annual rent divided by the property value divided by property value, it's in a range of 6 to 7% gross yield. Mortgage rates are close to 4%. Nowhere in the world has those dynamics. You go to the US, your rental yield is more like 4%. Depends on where in the US, obviously, but let's say major cities. And then your mortgage rates are 7.5%, where we are right now in mid 2024. So that dynamic is making it a lot more financially viable to buy as opposed to rent.
Yeah. And the only thing that could put anyone off, and let's be honest, because you have another product, the monthly payment calculator. I think it's called mortgage calculator.
Mortgage calculator, yeah.
That. So you think, okay, in my head, I'm like, 20% deposit, my upfront cost. But then when you add all the plus, it ends up being double the amount of your deposit after you factor in agent fees, after you factor in the transfer fee, surveyor's fees, all of that makes you want to go back to the rent search button.
So yes and no, right? Because some banks, in fact, most banks today allow you to include DLD registration and a real estate agency commission.
Yeah.
Let's say transaction fees allow you to include them in the mortgage. So
I saw that at the bottom. There's a toggle at the bottom, include the fees. So that's
look. I always say to people, if it's ultimately a financial decision. You can include them, or you can choose not to. Again, at rates as low as 4%. And remember, our rates are lower than the majority of markets, particularly Western markets. I think it makes sense because you're borrowing money cheap.
Yeah. Well, not as cheap as it used to be.
Look, it isn't, right? But let's face it, 1-2% interest rates, that's not normal.
Yeah.
Right? It was never, that wasn't cheap.
Yeah.
That was abnormally low.
For a long time.
For a long time,
Yeah.
I know. And we get spoiled and we get used to it.
Yeah.
And look, funny enough, a couple of years ago, almost everybody was speculating that with interest rates going up, the music is going to stop or home buying activity is going to slow down. And I we go through this chart with our team on a monthly basis, and it's mind-boggling. You see it. You see the dynamics differently. So, for example, in the US, the curve moves in the opposite direction. So, interest rates go up, mortgage activity goes down.
Right.
In here, they're moving in the same direction.
Right.
Why? Because of rents. Again, rents went crazy the last couple of years, they've in some areas, they've more than doubled.
I know. I'm in that. I'm in that mix. Okay. And in terms of the split now, would you say it's 50-50 cash and mortgage purchases? Or what are you
getting
seeing?
there. It's closer to like it's in the 40-something% on ready properties.
Okay.
So,
mortgaged.
Are mortgaged.
Okay,
yes.
fine. So just to kind of understand a bit about how to calculate it, let's say before you get to the calculator stage. In fact, no, before that. And I know the answer to this, but from a technical perspective, but your advice, you start shopping first or get pre-approval first?
Always get a pre-approval first. Always get I mean, look, for a couple of reasons. One is I think it gives the home buyer more credibility when they're engaging and interacting with real estate agents and potential property sellers, right?
Because they will ask that question.
Everybody will ask that question. Two is I also think it gives home buyers that more responsible approach because particularly when you're buying a home to live in, as much as it's an investment or a financial decision, it is an emotional process, right? And what you don't want to see is people going out shopping for homes, finding the home of their dream, and then stretching themselves in every possible direction and borrowing money from, aunts and uncles and brothers and sisters and friends to make that down payment or to make that transaction happen, and then going through financial stress. Now, you will find it quite often, and this is important to always advise home buyers, is particularly first-time home buyers, it's almost not normal not to have some level of stress, right? Financial stress when you buy your first property. And that's okay, but don't take, too high of a burden to a point where you're putting yourself at risk.
Especially if you lose your job or in those kind of scenarios. Okay. So let's say before you get your pre-approval, there are some calculations that you can do yourself. So there's a few rules of thumb when it comes to how much can I borrow or how much should I borrow. And I would say it's about 25% of your monthly income should go towards your rent or your mortgage. Am I right on that?
It depends on your other liabilities.
Okay.
So if we were to go by central bank rules, right? Central bank rules says all of your liabilities. So that is your mortgage, your car payment, your credit cards. Keep in mind, on credit cards, it's not how much you owe, it's what your credit line is.
Right.
Your personal loans, etc. All of which should not exceed more than 50% of your monthly income.
Okay.
Right? Now,
so they want you to have 50% of your salary put away each month.
It's not put away, right?
Well, that's
your
kind of
disposable
living,
income is going to go to, putting gas in your car, paying utilities, paying service charges for your apartment if you own an apartment or even a villa. School fees. You want to talk about this, right?
Yeah, that can be expensive. Yeah. Okay, because there was another calculator that I heard. 7 times you should buy a property that's 7 years worth of salary.
Yes, or less than 7 years worth of your salary.
Yeah, don't exceed 7x your annual salary. Yeah. So that's a nice kind of...
I mean, look, there are all kinds of formulas. Ultimately, it is a matter of personal choice. Some people do make that choice. We've made that choice as a family to say, look, we wanted a property that is fit for purpose. And, we did a remodel and, went all out. And that was very, very important to us. So, it was tight, right? But again, different people have different personalities. Some people cannot live with any level of financial anxiety. So they choose to go more conservative, live within their means. I admire them. I think, that's always the more prudent approach. But different people have, different personalities. But,
I love playing around with the mortgage calculator. And what's quite interesting is the difference between, if you're adding 1 million, if you're going up a notch, 1 million, it's only an extra 4,000 dirhams a month on your repayment. That's it. That could be 2 nights out at Zuma that you no longer go to, you scrap that off your list, and then instead you buy a property that's 1 million dirhams more. Or it could be a pair of shoes. Quite frankly, it's a pair of designer shoes every month that you sacrifice in order to live in a property that's 1 million dirhams more expensive.
100%. 100%. So look, I mean, and again, the mortgage calculator is a great guide to show you. But again, you want to keep in mind some scenarios, right? You want to look at what are your other liabilities, and then also keep in mind that, believe it or not, some people look at it simplistically in saying my mortgage cost versus my rental cost as a monthly payment. But remember, part of that mortgage is going to your principal. So it's forced savings.
Right. Okay. And then the other...
So even if what I'm saying is, even if in a world where your mortgage payment is slightly higher than your rent, but you're living in a property that you love and that you see yourself committing to for the next 3. So I'd rather see somebody stretching themselves a little bit, and live in the property longer, as opposed to going on the conservative side and then making a move in 2 to 3 years, because that move is more expensive and more risky. Because when you take a long-term view on a property, appreciation, depreciation, all of that becomes a lot less of a concern. Because look, we all know every market in the world, whether that be the UAE, France, Spain, England, US, etc. It's the nature of any market. You go through economic cycles. You're going to have ups and downs. We've seen ups and downs. You and I, within the industry, we've seen a couple of cycles, of the market going up 20, 30, 40, 50, 70, 100%, and then going back down and then going back up. So,
and it's interesting because there's a name for it. I think it's like lifestyle upgrade or something. Once you do stretch yourself a little bit, and I actually had one of my early day bosses. He used to encourage all the brokers to go out and get an expensive Mercedes on finance, go and buy a property. Not that he was pushing us into debt, but he encouraged us to stretch ourselves financially so that then our, income had to keep pace. And obviously we'd close more deals or make more money and so on to kind of keep up the lifestyle. So I completely agree with
So one of my really good friend and mentor is a high-profile figure in the private equity space. One of his profound advice, he's an older gentleman, mid-60s, and one of his profound advice to me is, always live beyond your means, because it keeps you going.
Yeah.
Now again, when you have a family and you have a wife and kids, husband, parents, etc., you always want to make sure that your family is protected.
Yeah.
So
don't be irresponsible.
Yeah.
Okay. And then the other thing to bear in mind is the length. So let's talk about mortgage typical length. So the standard is about 25 years. But if you're over 45, they'll cap it at 65. When you turn 65, they'll only give you a 20-year payment.
And this is one of the debates that we always have we try to have with the bankers, and ultimately I think a debate that should be had with central bank is why the 65-year-old age gap, right? Let's face it, if I'm 50 years old and I'm borrowing for a 30-year term, not even 25, right? Well, let's say 25-year term, and I'm now 65, then I would have already paid down more than half my mortgage. So the risk to the bank is almost non-existent. But it is what it is, and that is the rule. So the rules here are your mortgage term is capped by either maximum of 25 years or when age 65. However, there are unspoken of exceptions depending on the borrower's profile and the bank and the borrower's income and et cetera, where we can stretch that tenure up to 70 years old. So you can be 50 years old and have a 20-year mortgage as opposed to only 15.
I'm surprised they don't ask for medicals and stuff, or they don't look at health, do they? Or do they sneak into the
No, so there's a
medical
life
records?
insurance policy, and I will say it's one of my favorite documents to sign on a mortgage. I told my wife when I did it, I said, "Hey, I just realized I'm going to be, I'm worth a lot more dead than alive."
Don't give her any ideas.
Yeah, she listens to a lot of those podcasts, which yeah, the crime and disappearing people podcasts. Sometimes I
red flag.
Yeah. Yeah. But yeah, no, hopefully we're not giving her any bad ideas.
25 years.
25 years.
65, yeah. Mm-hmm.
So life insurance, yes. With life insurance, you sign a medical declaration form.
Right.
Where you declare any pre-existing conditions and etc. I always urge people to be factual. There's always the case that nobody thinks about, of God forbid, the mortgage holder is deceased, and then the insurance company can always find a reason to say, oh, you had a pre-existing condition. So if you do have pre-existing conditions, I always urge people to declare them.
Mine is the smoking box. So I mean, I'd love your opinion on this, but I used to smoke cigarettes.
Yeah.
Now I've switched to IQOS, which I don't consider smoking. So I think I would tick the non-smoker box.
Well, you know what IQOS stands for?
No.
It actually stands for I quit ordinary smoking.
I did not know. Did you all know that? They're all like, did you? I did not know that. Okay.
Yeah. Maybe that answers your question.
So if they need another box that says not ordinary smoking.
Are you an ordinary smoker or are you an extraordinary smoker?
I'm an extraordinary everything.
You are extraordinary, Silvia. We both know it.
Thank you. Right. Okay. So we've done the length of the term. Bank versus broker. Because your default is, the easiest thing for me to do is use the bank that I bank with. They're offering me a mortgage. Let me go with them. It's easier to just be in-house. Why should I go to a mortgage? A broker? What's the pros and cons of each?
What's more important, buying a pair of shoes or buying a house?
You're asking the wrong person. You're asking the wrong person. I love shoes.
Can we say they're equally important?
Look, as long as I have somewhere to live and I have nice shoes, I'm happy.
Look, if you're looking to buy a nice pair of shoes, do you go into one store, or are you better off going into 3 or 4 different stores?
Good point. I tend to go to a mall where there's multiple brands or concessions within the department store.
I mean, look, there's always a world where you say, I want to buy Louboutin or whatever, right? But there's a world where you wake up one day and you say, hey, I need some emotional support and I want to go to the mall and buy a nice pair of shoes, right? I do this sometimes. I'm sure you do. Now, but you don't really know what kind of shoes they want to buy, or let's say a watch or whatever that is. So you're always better off shopping around and seeing what other options you have. Now, jokes aside, your mortgage and your property purchase is often the most important decision that you make after marriage.
Agreed.
With that said, you go to the bank, you're going to get one option, and the bank is going to sell you on their mortgage product. You go to a broker or a mortgage provider, an independent mortgage provider, and then you have every bank in the country at your disposal, as opposed to only one.
So your advice, of course.
I would always go, definitely advise to go to a trusted mortgage broker.
Yeah.
And a trusted mortgage broker is, ask your friends, right? Check out Google reviews. Ask your agent for a recommendation, maybe. Always, definitely make sure that you're working with somebody trusted. If you can ask for references, like I said, check for Google reviews. They always tell you a lot. If you don't find positive Google reviews, maybe that's an alarming sign. Or you just ask for references.
Yeah. And there is another reason not to go with your bank, because if you do switch employment, there's that end of settlement, or not end of settlement. End of service. That triggers, red flags for the banks.
So we usually tell this to each and every single borrower we get, and we clarify that. We get a lot of borrowers who end up getting a mortgage through their bank, but through us. Right? Because we manage the process on their behalf, and it's better they get the same terms. So let's say you bank with
Emirates MBD.
Adib or Fab or Emirates MBD, right? You can come to Mortgage Finder. We can get you the mortgage through your bank, and we'll get you the same terms, just frankly speaking, better service.
Yeah.
Right. Now, we always advise people to say, even if you go through your bank, don't go for the salary transfer option. It usually comes at a lower interest rate. But then the issue that you're having is, if you feel that there's a risk of you exiting your role, then the risk that you're taking is the bank will then hold your end of service amount as soon as you exit.
Yeah. So it could be a bit of kind of financial complication. Okay. Speaking of financial complication, credit scores. How do I find out my credit score? What can I do if there was something on there that I didn't know about? Like, how often are things being discovered in the credit score that people had no clue about?
Yeah. Funny enough, we get a lot of cases where people get have credit cards that they didn't know existed.
Right.
So somebody who had gone for a car loan, and part of the, as they're signing the documents, the bank offered them a credit card and they checked yes, and then it shows as a credit line on their credit report. Anybody can pull their own credit report using AECB, so Al Ittihad Credit Bureau, AECB, just look it up on Google. And then they also have an app where you can download it, put your Emirates ID and your information, and then you get your credit report. So it's not just a credit score, it's a full report that shows your payment history and what your credit lines are with different financial providers.
So is it good to have credit cards that you don't use? Does that improve your credit score? Because certainly in the UK, we were encouraged to take out credit cards but not use them, or make sure we repaid them every month in full, because that gives you a bit of a boost. Or does that not really apply here?
No, look, I mean, it's all within a balance, right? So, definitely having a couple of credit cards with regular usage. What's very important is paying it off on time, or maintaining a low balance to credit line ratio. That's for a couple of reasons. One is financial responsibility, because credit card interest rates are borderline criminal, right? If you add it up for the year, it's higher double digits. It's very, very expensive. So you don't want to be paying credit card interest or profits. It's very, very high. Two is, again, in a world where you're adding that financial stress onto yourself, and in a world where you're forced to pay down your credit cards, you don't want to have that financial stress. Always, I religiously tell people, the one thing to watch out for the most is maintaining credit card debt to a minimum.
Okay. And what about your utility bills and stuff? Because there've been times where I've forgotten about an AC bill or paid my due Etisalat late. Does that have a...
Sadly, yes. Yeah.
How many days late?
So more than 30 days is what
triggers.
No,
that's not. It's more of a kind of reminder, like, oh, damn, I forgot to... Okay.
And like the nice thing about over here is, if you're, like I've been with Etisalat for, how long? 12, 13 years now. They call me on the day that my bill is due. It's not like a day after. It's like, hey, your bill... Dude, have I ever missed a payment?
Yeah.
No. Like,
I don't get a phone call. I just get the text message saying it's... Oh, maybe I clicked, don't call me.
Yeah. Maybe I should do that.
Yeah. So, and with the apps and everything, but in the UK, it's much, much easier because everything is on a standing order. You will not forget it. It just comes out automatically. Here, I have to manually have like a bill day where I'm just going to go in and pay everything.
Yeah.
But yeah. Okay. So I want to get your opinion on what makes sense. And this is your personal opinion. It's not to be construed as financial advice. But let's say you've got 1 million dirhams cash. Would you be recommending someone buy 1 million dirham property outright, or mortgaging 5 apartments and putting the, or mortgaging as many apartments and putting that money down as a deposit?
Are you buying to live, or are you buying to invest?
Investment.
Okay. So it's not that simple, right? Because you don't always mortgage. So your mortgage on your primary residence, the 20%, down payment applies. If it's an investment property, you need to have a higher down payment.
40%.
And again, I always say, look for, you wanna be in a world where your rental income is, or your mortgages, your mortgage and service charges, etc., is less than 80% of your rental income.
Okay, that's nice.
There's a couple of formulas that you want to apply into making these decisions properly. So it may not be 5 properties, it may be 3 properties, it may be 4 properties. The short answer is, again, in a world where rental yields are higher than mortgage interest rates, then yes, all day long, mortgaging an investment property is better than buying it cash. But that, make sure that you have that balance. And the reason you want to do this, because you want to account for vacancy. You want to account for, God forbid, something happening with the property. You want to account for interest rates adjusting, because remember, interest rates here are fixed for 2, 3, 4, 5 years, but then they become adjustable.
Right. And let's talk about that, the difference between tracker and variable. Can you explain the differences?
Yeah, of course. So you have 2 options usually when taking out a mortgage. You can either take a variable or what they call a tracker. And that is, there's an index called the IBOR, which is the Emirates Interbank offering rate. So it's usually IBOR plus a margin of, let's say, 1.5 or 2%. That's option A. Option B is, and that's adjustable from day one. So whatever happens to the IBOR, you just add 2% and then it moves up and down. Sometimes people do this when they speculate that interest rates are going down. Option 2 is to take on a fixed term mortgage that is often fixed for, the most common product here is 3 years. So fixed for 3 years, and then it turns into a tracker at the end of that 3-year
And
term.
you're either going off a cliff or climbing up a hill.
Yeah. So we're getting, naturally now, a very big portion of our business is mortgages that we had originated in 2021, 22 that are now coming back for a refinance.
Okay. And let's talk about refi, as they call it, refinance, or switching mortgages, or something else that is quite common in the UK. I don't know if it happens much here, is releasing equity to buy another property. Is that a thing here?
Absolutely. You can release equity either to buy another property or to renovate your property, right? You renovate your home. Now, with home renovation, some banks, they simply send you the money straight to your account and then you manage the renovation. Other banks mandate that they only send that money directly to the contractor. Right?
Interesting. Okay.
But again, and that's one of the benefits of working with a mortgage provider, because you can then have these options. When you go straight to your bank, you're usually bound by whatever rules your bank has. So those are usually the 2 common ways for remortgaging. The third one is you can simply remortgage without taking an equity release, just to fix your rate for another longer term.
Okay.
Now, it's been extremely common, because think about what happened the last couple of years. Property prices appreciated big time, right? And
unexpectedly.
I think expectedly.
You think?
I absolutely.
I thought after the C word, everyone thought it was going to be an absolute disaster. Maybe not everyone, but
look, I've said this quite often. I don't advise people to bet against Dubai, right? It's a city with an incredible regulatory environment, with leadership that knows what they're doing, with almost an obsession to advancing and being the best of the best anywhere in the world. You look around you, we've got a great environment. I wouldn't bet against the city, right? Now, the reason why I don't say it is expected, or it has been expected, is, and people aren't really paying attention to this. You're looking at property values in absolute value, as opposed to looking at it in inflation adjusted value. Because if you look at property price levels today, adjusted for inflation, they're actually less expensive than where they were in 2015, 16. So, yeah.
Okay. I like that. Don't bet against Dubai. Okay. Self-employed people and freelancers. How do the mortgage options differ if you're self-employed or if you're an agent that's commission only, or you're a freelancer of some sort?
Most banks will either not lend you or put you through hell and back. We can show you vouchers. Okay? But that's again not all banks. That's most conventional banks. That is where working with this is, I think, particularly for somebody who's a freelancer, real estate agent, or self-employed or non-resident. This is particularly the case where I would advise them to go to a mortgage broker, because then they would save you the time and trouble and drama of going to one bank at a time and getting rejected. Our team would know which banks would lend you and at what terms ahead of time, and they'll help guide you properly.
Okay. And what about employment probationary periods? Like how does that affect mortgage eligibility? You've just started a new job or you've just arrived in the city.
Yeah. You need to apply after you've passed probation.
Okay.
Again, there are some exceptions of banks who would lend you while on probation. It is extremely uncommon.
Okay.
And look, part of it is also, I think, being financially responsible. If you're facing the risk of not passing probation for whatever reason, do you really want to take on a mortgage liability? Because it is a liability.
Well, you could actually request that if that's your intention to buy a property, you could negotiate your probationary period is reduced from 6 months to 3 months, perhaps. Yeah. There's that to think about. All right. What happens at the end of the 25 years? Because I'm approaching that stage on some of my properties where I'm like, hold on a second.
That's amazing.
Time is coming, yeah.
Did you buy your first property when you were 12?
2007.
And you were 12?
No, I was.
I
was 12. I was 12.
They gave you a mortgage when you were 12 years old?
Unbelievable. These Annie Mac and Freddie May crooks.
Yeah.
And actually, my first mortgage was 100% mortgage, where they just gave you the whole amount. You didn't have to have any down payment or anything. No.
The real answer to your question is I don't know.
You just because I had interest only.
Yeah.
So that was an interest only. So I've only paid the interest, not the principal. Yeah. So I have to just sell it at the end, which has made it's gone up considerably, but generally you're supposed to own it at the end of the 25 years.
You do own it, yes, 100%. So that we know. Now, if you're asking me, what's the process? Do you get a call from the bank? Do you call them? Does anybody come and give you a hug and say hallelujah?
No, we don't know what happens.
I don't know.
Okay, no one's reached the end of the 25
but yes,
years.
you will own. You will really own your property, because remember, when you buy property through a mortgage, the mortgage is mentioned on your title deed. So I would imagine you go down to the trustee office and say,
get them removed off.
I think you get a document from your bank that says my mortgage is paid off, or I have no liability, and then get them to remove it.
So if anyone knows what actually happens at the end of 25 years, if you've been a mortgage holder for that long, drop it in the comments.
Yeah.
Next generation of home buyers. I know, we're probably the same generation. We always had it drilled into us, own property.
Yet you look so much younger than me.
Funny how that happens, but yeah.
That's the property finder colors.
Yeah. They enhance my complexion. Are you seeing any trends when it comes to the age of first-time buyers, or are people waiting for longer? Is the next generation so done with that measure? They'd rather invest in other asset classes. Are we seeing any kind of shift since your 20, the beginning of your mortgage career?
It's a very, very good question. We publish those on an annual basis with our Mortgage Finder annual report. We're definitely seeing that scale sliding younger and younger over time. Interestingly, those dynamics are different between one global city to another, keeping in mind that the UAE we are a young population, so
lots of entrepreneurs.
What applies here isn't necessarily similar to what applies elsewhere in the world.
Right, let's move on to home buyer tips, because this has all been home buyer tips, educational, but we're going to separate three sets of people. So we're going to talk about the end users, the investor, and the real estate agent. So what do you wish the end users knew about mortgages?
Go to a broker as a trusted mortgage provider or a broker as opposed to going to your bank, so you can have more options. Right? That's number one. Two, if you're a first-time home buyer, stretch yourself within limits. Right? So make sure that that your family is secured. Right? So think with your mind as well as your heart. So it's not all emotions. Definitely apply some sense. Three, and this is another part of working with a trusted mortgage provider, ask your mortgage provider to review the MOU and the purchase agreement, right?
Can they do that? Would they do that?
So our mortgage advisors always review, and it's a complimentary service that we offer. What we look for is there's something, and this is, I think, the one advice for people to walk away with, is always make sure that there is a term in your MOU about valuation, right? Because if subject to bank valuation, because if, let's say, your valuation comes back and it's 20% below your purchase price, then you won't qualify for that mortgage anymore, and your transaction falls apart and you just lost your deposit, right? So make sure absolutely that there's that valuation clause. That is advice that applies to first-time home buyers, to investors, and to real estate agents, because the last thing a real estate agent should want is drama halfway through the transaction.
Okay, that's superb advice. Thank you very much.
Valuation clause, make sure it's there.
Okay, and if they don't have it, they can reach out to everyone. Go buy it.
Don't buy the property. Go buy another property. There are times when a seller would refuse, and we usually advise. But again, that's the distinction between a trusted mortgage advisor and a
cowboy.
Yeah. Thank you.
Okay.
And we always in our team does this incredibly well, and so do many people, I'm sure. Being an advisor is it's a big responsibility. You're advising people on the most important financial decisions that they're making. So I would say if you're a mortgage broker or your real estate agent or your buyer or your seller are pushing you against doing what is logically correct, don't buy the property. There will always be another property.
Walk away. Okay. Fantastic.
And yes, your husband or your wife is going to tell you, but I love this. It's a corner plot. There'll be another corner plot. Don't worry.
Yeah. Okay. And what should investors be aware of when considering mortgages?
So always look for that balance of making sure that your mortgage payment and service charges and maintenance provisions, etc., is within that 80% of rental income range. That's absolutely important. Watch out for those service fees, right? And also, there are so many tools on the market and great companies like Keeper, for example. If you want to work with a property manager, you want to assess whether you're better off doing short-term rentals or long-term rentals. What are your objectives from this property? How important is liquidity? So, for example, if you want to be in a position to be able to sell that property on a short notice, or move into the property yourself, then short-term rental becomes becomes more relevant.
And lastly, I would like to hear from you. Why choose Mortgage Finder to finance my next? To broker my next mortgage?
Trust, right, is in one word. And look, this is something that we've been hyper committed to as a team and as a company. With a brand as large as Property Finder and Mortgage Finder, maintaining trust and taking that responsibility seriously is extremely, extremely important. There is one metric that I, as the MD of the business, focus on. What do you think that is?
Revenue?
Nope.
Retention?
Nope.
Referrals?
Nope.
Reviews?
Google reviews. So the one thing that I talk about most religiously is Google reviews. I read them every single day with my morning coffee.
That's your thing, yeah.
It's my thing. It's what I enjoy. It's what we love. And that's not just about me. You would see we have a WhatsApp group with everybody on the team. That's what everybody celebrates. You'll hardly ever see somebody saying, congratulations so-and-so on closing 100 million dirhams last month. That's not really a thing. Congratulations so-and-so on closing 30 transactions last quarter. It's not a thing. What
That's
you see even the team celebrating each other for is customer reviews, because we literally obsess with home buyers. And we even say it on the website, and we're not shy to say this. We work for home buyers. We don't work for the banks. A lot of real estate agencies, and we have hundreds of real estate partners who choose to place their trust in our team, our mortgage finder, not only because we have members on our team who have been doing this for nearly 20 years, but also because they know that they're referring their home buyer to somebody that they can trust and somebody who will look out for them.
Yeah, and it's really important, because I always went by the saying, people respect what you inspect. So as a leader, if you are obsessed with Google reviews, well, guess what your team are going to be pushing for all the time? It's those Google reviews. I'm done. Mohamad's asking me for another review. Where are my reviews?
No, I don't ask people, by the way, for reviews. I just celebrate them, right?
But it must then become part of the culture that your people are asking for reviews, because they know it pleases you so much.
It's entrenched in the culture, right? And thankfully, it pleases everyone. It's no longer about just making me feel good. It really, everybody now in the company, it became a thing. It became entrenched in our culture, customer centricity.
And then, but the other thing, that flip side of that, because I used to obsess over reviews as well. But when you get one bad one, how do you have any bad ones? Do you ever?
Everybody has a bad review every now and then. We have close to 700 reviews now, and at 4.9. So obviously a lot more 5-star reviews than now. Interestingly, Google reviews often tend to be either 5 stars or 1 star. Nobody ever rates you 4 stars or 3 stars, right? Because if somebody's taking that time to review you on Google, they're either very happy or they're very unhappy.
Yeah.
What we do is, many times, so either our head of mortgage advisory, Sam, who I believe you may have met, or a member of our management team will call that customer to better understand. The first course of action is to say, hey, we see you're unhappy. How can we take care of you? After we've taken care of them, we then ask them, hey, if you feel that we've taken care of you. And look, sometimes customers, sometimes they wake up on the wrong side of the bed.
Yeah.
Sometimes they don't know that it was the bank who changed the term halfway in between. Ultimately, we are held responsible.
Yeah.
And everybody makes mistakes.
Okay, brilliant. And there is that opportunity to give good customer service by turning around a negative review into a positive.
100%.
By the way that you handle it.
But it becomes a crisis. It's like a natural disaster if there's a 1-star review on Google.
Okay, you're sitting there with your coffee and it's like, what? Brilliant. Well, Mohamad, thank you so much for sharing your expertise and your valuable insights. I've really enjoyed that. I've learned a few things as well. And I hope you enjoyed that. If you do, like, share, and subscribe. Thank you very much.
Thank you.